There is one force behind every major financial collapse in history. It is not greed. It is not corruption. It is not bad luck. It is debt. Debt is quiet. Debt is normalized. Debt is encouraged. And because it feels ordinary, most people never see the danger until it is too late. In this episode, we expose the one ingredient that appears in every financial crisis, no matter the country, the century, or the system: debt. Most people think debt is simple. You borrow money, you pay it back. But at a system level, debt works very differently. Debt pulls future money into the present. It allows people, businesses, and governments to spend tomorrow's income today. When used carefully, debt can help growth. When used excessively, debt guarantees collapse. Every financial crisis begins the same way. Too much future is spent too early. Debt always looks harmless in the beginning. Prices are rising, jobs are plentiful, credit is easy, banks say yes, governments encourage borrowing, media celebrates growth. Debt creates an illusion of prosperity. People feel richer, businesses expand faster, governments promise more. But this growth is not real, it is borrowed. And borrowed growth always demands repayment. Let us go back to the 1920s. America was booming, stock markets were soaring, factories were expanding, confidence was everywhere. But beneath the surface, there was a problem. People were buying stocks with borrowed money. This was called buying on margin. If prices went up, profits were multiplied. If prices went down, losses were multiplied too. When confidence cracked in 1929, prices fell. Margin calls followed. People were forced to sell. Selling pushed prices lower. Lower prices triggered more selling. Debt turned a market correction into a depression. Without that debt, the collapse would have been painful. With it, the collapse became catastrophic. Debt is dangerous because it removes flexibility. When you owe money, you cannot wait. You must pay, no matter what. That is why debt amplifies panic. A small drop becomes a fire sale. A small slowdown becomes mass unemployment. A small mistake becomes a systemic failure. Debt makes systems fragile, and fragile systems do not bend. They break. Today, debt is everywhere. Households borrow to survive. Businesses borrow to compete. Governments borrow to function. Global debt is larger than the entire world economy. This has never happened before, and it only works if everything keeps growing. More jobs, more consumption, more borrowing. The moment growth slows, debt stops being invisible. It becomes the problem. The 2008 crisis was not caused by housing. It was caused by debt. Mortgages were given to people who could not afford them. Those debts were packaged and sold as safe investments. Risk was hidden. Responsibility disappeared. When homeowners stopped paying, the system froze. Banks did not trust each other. Credit stopped flowing. The economy stalled. The world learned a painful lesson. Debt does not disappear when you hide it. It only grows more dangerous. Here is the part that shocks most people. After every financial crisis, debt does not shrink. It grows. Governments step in. Central banks print money. Interest rates are lowered. This makes debt cheaper. So the system borrows even more. Each crisis is treated with more debt. This is like trying to cure addiction with a larger dose. It works briefly, then the problem returns, bigger than before. Debt keeps the system running. It fuels consumption. It boosts asset prices. It creates the appearance of stability. Calling out debt would mean slowing growth, and slowing growth is politically dangerous, so debt is rebranded. Good debt, smart debt, necessary debt. But debt is still debt, and it always demands payment. When debt collapses, it is not shared equally. Those with assets are protected. Those with power are rescued. Everyone else pays through unemployment, through inflation, through reduced services. Debt concentrates risk at the bottom and protection at the top. That is not an accident. It is how the system is designed. Debt is the silent engine behind every collapse. It makes growth look easy. It makes risk look invisible. It makes collapse inevitable. Crises do not come from nowhere. They arrive when debt reaches its limit. In the next episode, we expose where most people believe their money is safe: banks. And once you understand how banks really work, you will see why trust is the most dangerous asset of all.